Hello and namaskar viewers, I am Sanjeev Pandya welcoming you to this week's edition of the Season 4, the Tax Talk, right here on ITV Gold. Happy to be with you as we bring you all the tax related updates, changes, tax laws, kya hua, kya nahi hua. We get all the information and a guidance from a very reliable source. First of all, the show is brought to you by CPS Services, a full-fledged accounting, very professional accounting firm located in the state of New Jersey with multiple locations, and they can assist you with your personal taxes, corporate taxes, taxes related matters. If you are thinking about starting your own business and you need to set up an entity and you're not sure which one to set up, Science CPA Services and their knowledgeable and experienced on-hand CPAs can guide you and assist you in the right direction. So for any tax matter, give them a call at 908-888-8900 or visit their website sciencecpaservices.com. With that note, I'd like to introduce Mr. AJ Kumar, CPA and MBA with Science CPA Services, who joins us every week, and under his guidance and directions we come to know about the taxes. AJ, good to have you in the show.
Thank you, Sanjeevji. Thank you for the kind introduction.
You're very welcome. Now we are here in almost end of January, and the tax season is really heating up because you must have gotten your W-2s or 1099s and whatever the tax related documents you must have gotten, or they must be on the way. So now today, instead of taxes, let's talk about audit checks by IRS. Why do IRS check on the audit? What are the main reasons that IRS picks up the tax return and sees something not right? I'm not saying something wrong, but something not right. Maybe you missed something. And that's what the IRS audit check is, and there is a long list of those audit checks. So AJ will go step by step and explain to us what are the common errors that we should not make, so that way your return is not audit checked by IRS.
Absolutely, Sanjeevji. As much as we get a lot of calls how to lower the tax liability, but when it comes to taxes, it's not just about minimizing the tax liability. The last thing you want is IRS on your back. Last thing you want is something missed on your taxes. And remember, if you pay more than your fair share, IRS is not sending back a letter to you, you paid me more, here is your money. On the other hand, if you pay lesser than what you should have paid, they are happy to send you the letter. So accuracy is what's more important than minimizing the tax liability. When it comes to audit, it's a computer software. There are a lot of things this computer will automatically check and will generate a notice if things are not aligned properly. So in this episode, we'll try to highlight certain things, 10 common mistakes, 10 main things that you can be careful. So it's more about on the caution side, stay on the precautiously, what can you do now to ensure your audit probability is minimized, not just the tax liability.
Okay, very well. So let's start with the item number 1, which is round numbers. What's wrong with the round numbers?
Well, I'm glad you asked. So if you have a small business and you are reporting the income, expenses, and all are round numbers, 1,000. Income, 20,000. Travel expense, 1,000. Uniform, 2,000. Rent, 10,000. Phone, internet, 3,000. All these numbers feels like they are made up number. They may be right, but they feels like you don't have proper documentation around it. They feel like estimated numbers as opposed to accurate numbers. So the software, computer software, will detect all the rounded numbers. Rent could be rounded, $1,000 a month. But think about it, can the utility bill, can the travel, can a lot of these bills really be rounded as much? And if you see everything in thousands, the computer software will generate a notice, please provide the necessary support. So having all these rounded numbers, especially on the business side, can actually generate an audit.
Okay, so these are the round numbers that one need to be very careful. Don't make it so obvious when it comes to round numbers, right?
Yeah, it's common sense.
Okay, so after the round numbers, now let's go into other things. As you know, number one thing, viewers, that you should really know that when you file a tax return and whatever the deductions you are claiming, make sure you have supported receipts to save them. You never know when IRS is going to come and ask for it. So receipts are important. The reason I'm talking about receipts because now I'm going to lead into the second point, which is a cash related business. If you are in one of those cash related businesses, there are certain things that you need to be careful.
Absolutely. I'll add to that the receipts have to be contemporaneous in nature. You cannot really say if the need be, I can get you the receipt. At the time of filing the taxes, the receipts must be there. The other thing, having the receipt only does not make it a legitimate expense. You have to have the proof of payment. Take an example. You can go to Home Depot, stand outside the Home Depot door. By the evening, you have $10,000 worth of receipt in your hands. Does it mean you have 10,000 of expense as repair and maintenance? You have to show proof of payment. How did you make that payment? Just the receipt alone is not a sufficient proof. Receipt along with the proof of payment is what makes it a legitimate expense. Here, as a second red flag, second precaution that we are talking about is the cash intensive business. We know laundromat will have cash. We know the grocery store, typical ethnic grocery store, typical ethnic restaurant, they have some cash. So if we are reporting your income tax has only the bank deposits in, it's a red flag. The system, IRS has the access, the right to collect all your bank statement. They will see how much revenue, how much gross receipt you are reporting. If your gross receipts is matching exactly with what the bank deposits are, you missed something. You did not report any cash. Especially for cash intensive business, you must add some portion. We don't really know. The system doesn't know if the cash is 5,000 or 15,000. The problem is not reporting any cash is what creates problem.
Very good, well said. Now that prompts me to ask a question. In today's digital age and the payments and everything with credit cards and Google Pay and everything else, you think there are some business are still heavily cash generated?
It's not about heavily or less cash. There are certain type of business where you know the cash is going to be there.
Okay.
There are some companies, IT consulting company, they probably don't have any cash. Especially with a lot of professional services, we are okay with not having any cash. But how do you justify having no cash on a pawn shop? How do you justify having no cash in an Indian restaurant? So some cash is a good idea. When you do the taxes, show some cash over there.
Okay, all right. So now let's go quickly to the next category. When you fill out your tax return, make sure that your income is stated correctly. Missing income, in case if you miss something, it could send a red flag to IRS.
It's more than the red flag. Think about it. When the W-2 or 1099 is issued to you, a copy is submitted to the IRS.
Correct.
A copy goes to the state. So the system, the computer, the software already knows what your income should have been. So if you miss one 1099, some interest, some rental income, the system is expecting to see that income, and if that income is not there, an automatic letter is generated. We want to look at your taxes. We believe your income is understated. So making sure all your income is stated properly on the tax return is a very good idea.
Okay, very well said. So that is the income part. Now continuing with this one, everybody wants to take as many tax deductions or tax breaks possible, but you need to make sure that they don't exceed to your income, right? Don't be that silly to have your deductions higher than your income.
Well, not that it's not possible. So if you have a new business, it's possible to have more investment in the business or showing losses in the business. The problem is when you continue to show losses year after year after year, then there comes a time when you say, why are you doing it? Why don't you stop this nonsense and stop losing money? So the point is, showing losses or having expenses more than the income by itself is not a trigger, but creating a history around it, showing losses consistently year, after some time, the system will say, this is not a business, this is a hobby. You are intentionally investing money because it makes you happy, not that it's a business. If it was a truly business, why would you be doing it? Why can't you stop? Why don't you just stop it? So they will say, we are denying your losses because hobby losses are not tax deductible. Business losses are tax deductible, but if it was business, 1 year is okay, 2 years is okay, but how long are you going to carry this thing? So that's the trick over there. That's the problem over there.
All right. Talk about trick and the problem. Foreign accounts. You may think, I don't need to do anything with foreign accounts and nobody's going to know because only I know it. how IRS is going to find out, but there is a way that it can be found out. So you
Absolutely.
also need to be careful with foreign accounts.
100%. And there are several ways, several triggers the IRS will know the foreign accounts. First example, we know how much interest income you are reporting. Remember we said the 1099s are reported to the IRS, to the state. Your foreign interest, if you are showing the interest income on your Schedule B and your foreign interest is, let's say, $5,000. We know in this country, the interest rates are 2%, 3%, 4%, not more than that. If your interest income is $5,000, you must be having at least $100,000 in an account. When you show foreign interest income, and if that interest amount is large enough, we know you had more than $10,000 at least for one day. That creates an F-bar account. Then we want to know, what did you do with this money? Is it still sitting over there, or did you buy an asset? That triggers a FATCA account. On Schedule B, in the last section, section C, or at the bottom, there are questions. Did you have foreign bank accounts? A lot of people will say yes, and they will forget. They will not know that there is another form, FinCEN 114, F-bar forms that needs to be filed. So make sure all your foreign accounts are reported. If you had more than $10,000 at any given point of time during the previous year, all the bank accounts combined together, you have triggered F-bar. If you had more than $100,000 married filing joint at the end of the year, at the end of the previous year, in foreign asset, land, shop, inherited home you had, and we are looking at the market value for FATCA, not the purchase price, then you have the FATCA 8938 filing obligation. So please make sure you're reporting F-bar and FATCA. These reporting does not create any tax liability. This is information filing, but it helps you bring the money back. If you sell the asset tomorrow, you can go back to IRS. Remember, I told you this asset for last 3 years is the same money I'm bringing in. So there is no taxes over there.
All right, and there's a better trail and there's a correct direction to that. Make sure that you keep that in the mind. With that note, we're going to take a break, and when we come back, we got more IRS audit related matters, the points coming up right after this messages. Stay with us. Welcome back to the second half of the season 4, the tax talk, right here on ITV Gold. Viewers, the show is brought to you by Science CPA Services. A professional accounting firm can assist you in any tax related matters, but more than tax related matters, they can also assist you with payroll services. You need a virtual CEO, virtual CFO. Like I said earlier, that if you're thinking about starting your own business, which is really good, but what kind of entity that you need to set up. And the other important thing is IRS tax audit. Just in case if you have IRS tax audit and you're not sure what to do, please do not ignore that notice. Visit Science CPA Services, give them a call, make an appointment, and have them review it. They can definitely help you out, as they have helped many individuals over the years with the high IRS tax audits, resulting in almost nothing to pay or even getting a refund. And that's why you need professional tax accountants and the CPA firm, and their on-hand staff will definitely help you. You can give them a call at 908-888-8900 or visit sciencecpaservices.com. In today's episode of the Tax Talk, we're talking about IRS audit related matters, audit checks. What really triggers IRS audit? We covered some of the points. Now let's see. Lose money consistency. People like to show losses. Say, okay, I had a loss 1 year, second year, third year, 4 year. But is that consistency good enough? Can it trigger an audit?
Absolutely, especially when you have no income. A lot of people on W2 will create a shell structure where the intent is not to make money, and they will continue to show various losses: travel, meals, utility, office expense, home office, and those expenses actually help them lower the tax liability. If you remember, if you are on W2, you are not allowed travel expense, meals expense, entertainment expense, utility expense, home office expense. They are not allowed if you are on W2. But if you have a side business, if you have a small business, all those expenses becomes tax deductible. So that's the game here. If you have no income coming in and you continue to show losses year after year, it creates a red flag. It creates a situation, is this a legitimate business? You have been doing it for so many years, year, 2 years, 3 years, it's not making any money, but you keep claiming the expenses around it. Is this a business or a hobby? Is this a shell company? That's what you need to be careful about.
Okay, that is a very interesting point. Now, earlier we talked about income, that income you also need to keep an eye on it just to make sure that you report right income. But now here is something important point to discuss. If you are earning more than $200,000, that's something that you need to be careful for.
Absolutely, Sanjeev ji. So if you look at the IRS audit rates, people who make higher money, their audit probability is much higher. On an average, the audit probability is less than 0.5% if you count the whole population. If you look at people who are making $1 million or more, their audit probability is 8% higher. There are two ways to look at it. First way, people who are making a lot of money, they have a lot of complication in their taxes. That's why their audit probability is much higher. The second way to look at it is, it's a business for you, it's a business for IRS. If IRS starts auditing everybody who is making $10,000, $20,000, $30,000, how much money can they collect from this person? If you have the same time spent on somebody who's making $1 million, you can easily collect some money. Meaning, a lot of people can get away with doing silly mistakes if they are making no money. Higher the amount you are making, higher the money you are making, more careful, more kosher your tax has to be, more precaution you have to be using while filing your taxes.
Okay, that's a good point. Now, another thing that you should remember is, having a property for rental is always a great idea because it generates a side income and it always helps. But should you be careful that you want to make sure that you don't show losses year after year on that rental property. You're collecting rent, but you're showing losses intentionally, that could create a problem.
Absolutely. The two parts to it. And it's not about showing losses. Most rental properties are expected to show losses. After you take the property tax, mortgage interest, and more importantly, depreciation out of it, most rental properties will show losses. That's okay. The problem is, you cannot show active losses. Active means you can offset your regular income with this loss. Rental losses are expected to be passive losses. So again, the problem is not about showing losses. The problem is more about showing that the loss is an active loss and trying to offset your regular income. The active rule is you have to be investing at least 1,000 hours, unless you have multiple properties, lot of properties, or unless you are a realtor, a real estate professional, claiming that this is my active business, I'm investing more than 1,000 hours in this business, is not practical. I mean, if you have a rental property, you go there once a month, half the time the rent is sent to you via Zelle or wire transfer or via check. Are you really investing 1,000 hours? And then you have to keep a log. What exactly did you do by day? What do you do? What you did? How much you traveled? And that's how you have to justify the active losses. So active losses is what creates problem when you have a W-2 job making a couple of $100,000. Your wife is working, you are working, and the rental losses are active. You spend 2,000 hours on your job. Where do you have time to spend 1,000 hours on this rental activity? That's what creates problem.
Okay, very well. Now let's go into the entity, because sometimes people start a business and without really enough understanding of it, what kind of entity is really good for their personal tax returns and personal tax status. Sometimes they really set up a wrong company and whatnot. And that's why I say that Google is not always very helpful. That's why you need a professional CPA firm to help you out. What happens if you have a wrong entity set up?
Absolutely. So the US government allows 5 types of entities: proprietorship, partnership, LLC, S Corp, and C Corp. The biggest audit or biggest mistake that we have seen, especially for the people who started their own company, is between LLC and S Corp. So LLC pays 15% extra taxes. We call it self-employment taxes on the net profit. S corporation does not pay self-employment taxes. So the Google Gyan, or what you read on the internet, is you start S corporation, but people fail to understand in S corporation, if you have activities, not the profit, if you have activities under the S corporation, you are expected to have the payroll. That's the rule. That's why they are not charging you self-employment tax, because you are paying the payroll taxes, you are running the payroll, and payroll is mandatory for S corporation. So people create a situation when they started an S corporation, did not have the payroll, and now they are not paying self-employment tax on the profit because it's an S corporation. IRS does not like it. If you have S corporation K1 showing profits and you have no payroll, IRS will send back the notice to you, why did you not have the payroll, and they will try to charge the self-employment tax or the payroll tax on the total amount, total profit, say this should have been the payroll. So just be careful when it comes to the LLC versus S corporation.
Okay, very well. A business vehicle, because people really like to take as much deduction as possible on a business vehicle. Would you like to add anything in that category?
Absolutely. So make sure if you want the depreciation, business vehicle is under the business name, not under the personal name. If you want to make the lease payments out of the business account, make sure the vehicle is leased by the business, not under the personal name. And make sure the business is used 100% by the business. If you intend to make 100% of the lease payment, then you better have another car at home. I mean, your wife drives a second car, but at least you have some claim that on the weekend we drive that car, and this car is mostly, a majority is used by the business use as opposed to the personal use. So just be careful what your story is. If you're trying to claim 100% of the vehicle in the business, ask yourself, is this vehicle used 100% by the business? Or try to claim 90%, 80%, whatever your story is, whatever makes sense in your case. But just be careful what your story is and what you're trying to claim as a deduction.
Okay, now AJ, we have last 2 minutes in the show. We talked about audit checks and you really gave out information on each one of them, that what really triggers IRS audit. In the last 2 minutes, please tell us what to do if you are audited by IRS.
Absolutely, I'm happy to. So first thing first, if you are being audited, you do not ignore that letter. It's a government system. It's not going to go away by itself. You have to take action. Second, do not panic. It's not the end of the world. Millions of people get this letter every day. Take some time, read through it. If you do not understand it, there is a phone number, IRS phone number that's given on the notice. Make sure it's not fraud. A lot of fraud notices are sent out. Don't send a check. Don't rush into sending the payment. A lot of fraud notices send this letter with couple of $100 of request. Don't do that. Call the number. Don't call the number on the notice. A lot of time those numbers are fake. Go on the internet, find out IRS number. The IRS number is 1-800-829-1040. That's an IRS hotline. You can put it on Google, IRS hotline. Get the number from there. Call them with your social security number. Ask them what the notice is about. If you have a CPA who prepared the taxes, send a copy of the notice to the CPA. Not only they can help you see if it's a fraud notice, if it's a real notice, they can help you understand what the notice is trying to say, what the notice is all about. Make sure you respond to that notice, and a lot of time, if the notice is small enough, work with your CPA and get it settled. You don't want to get into this fight. IRS has an army of employees. The accountant will charge you by the hour, by the minute. So make sure you stay on the right side of the law. As much as, again Sanjeevji, everybody wants to save taxes, but nobody should be audited. It's extremely stressful to be audited by IRS, and there is no limit. IRS can take it for years. You can't afford to be fighting for years. So make sure you do your taxes right.
There you go, to do your taxes right. And if you are doing taxes on your own and if you're audited, that means you need to consult a CPA firm. And Science CPA Services can be your perfect answer. They can help you to resolve that IRS tax audit matter. So for that reason and for any tax related questions or concerns, do call Science CPA Services 908-888-8900 or visit their website sciencecpaservices.com. Every week, same place, same time, we bring you this tax related updates and change in the laws and information that you really need to know, courtesy of Mr. AJ Kumar of Science CPA Services. With that note, we come to the end of this week's episode. AJ, thank you so very much.
Thank you, Sanjeevji. Thank you.
All right, and I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.